If you've been watching the news lately, you know that there's a lot of things going on now. Every single day there seems to be something new out there. Whether it's something that Elon Musk has said, something that Trump has said, something that Trudeau has said, or whether it's about the tariffs. Whether it's tariffs on the US, on Canada, on Mexico, on Europe, on China, China implementing tariffs on Canada. There's so many different things, and all of these things are actually impacting the markets and your investments. So now is really a good time to reconsider how you're actually investing your money. I'm gonna give you some tips and tricks on how to get through this time period, so then that way you're not completely losing your mind in times like these. Hi everyone, welcome back to another video. My name is Ali. I'm a certified financial planner based out of Toronto, and today I want to give you those tips and tricks on how you can actually manage your investments in times like these where there's a little bit more volatility and ultimately when it looks like there's a little bit of a down market. So let's get started. When the markets are a little bit more volatile and you start to see your investments fluctuating on a day-to-day basis, whether it's going up a couple percent or whether it's going down 5 or 10%, this is really a time for you to reconsider your strategy when it comes to actually building out your investments. Now, this really comes down to a couple of things. One is your time horizon and how far out your goals are, and what it is that you're actually investing your money for. The second thing as well is you have to consider what is it that you're investing into. What types of investments? There's a lot of different types of investments out there. It's not just stocks, it's not just ETFs, it's not just mutual funds. There's a lot of different types of investments out there, and you need to know all of the different types to make sure that you're protecting yourself in times like these where the market is a little bit more volatile. Let's first start talking about the time horizon. When it comes to building out your investments, your time horizon is a very important thing to consider. Whether you're investing for the short term or whether you're investing for the long term, your strategy should be very different for either one of those directions. If you're looking to use the money in 1 year, in 2 years, or in 3 years, if you're invested in the markets, you should highly reconsider whether or not you should be investing in the markets. What I would probably do is I would consider looking elsewhere for investing for the short term. Now, this is really where diversification is really important when it comes to the different types of investments. When we take a look at investments from a risk perspective, stocks are considered to be some of the higher risk investments that are out there. There are some that are a little bit higher risk, like cryptocurrencies and some options and things like that. But for the average individual, stocks would be considered a higher risk investment. Now, if you were looking for something that is lower risk, then you would probably look at something like a bond. And a bond is really where you get a little bit more stability. This is where you're able to grow your money, maybe not as quickly. However, it really does help stabilize your investments. So if you're currently investing for the short term, you might want to look for something that has some exposure to bonds, or sometimes it's called fixed income. So then that way, the amount of exposure that you have to the markets, especially in these volatile times, is significantly less. And that will ultimately lead to more stability in your investments. So then ultimately when you go to use the money, whenever that is, whether it's 1, 2, or 3 years out, you at least have a better potential outlook on your investments. Now, when it comes to investing long term, this is really where the thought process has to change. If you need the investments 10 years, 15 years, 20 years out, whether you're saving for retirement or whether you're saving for something else. And ultimately, these little hiccups along the way, that's really all it is. It's small bumps along the way. And ultimately what you'll find is you need to stick to your strategy right now in terms of investing, but you might want to be a little bit more strategic in terms of where you're investing the money. So say for example, you still have 10, 15, even 20 years. If you're currently investing in ETFs or mutual funds that are primarily stocks, or if you're investing in individual stocks, you might want to start looking elsewhere from a regional perspective of where your risk exposure actually is. Just to put it into perspective for you, the Toronto Stock Exchange, the TSX, year to date, as of recording, is down 1.25% for the year. Now, if we take a look at the US, the S&P 500 is actually down 4.8%. And if you take a look at the NASDAQ, which is more tech heavy, is down 7.8% since the beginning of the year. Now, if we take a look though at different regions of the world, let's take a look at Europe. In the UK, year to date, they're actually up 4.5%. In Germany, they're up 13.9% for the year. And in France, they're up 8.25%. If we take a look at Asia, in Japan, they're down 6.6%. But then if you take a look at Hong Kong, the Hong Kong Stock Exchange is actually up 17.6% for the year. So as you can see, even though there's a lot of chaos and turmoil here in North America with all of with everything that's happening, there are still opportunities for you to actually make money with your investments. It's just a matter of finding those opportunities. This is why diversification in terms of regions is very important. So if your overall portfolio is in Canada or the US, you're probably down compared to where you were at the end of last year. Now, if your portfolio though was a combination of Canada, US, Europe, and some Asia, then you're most likely up a little bit. Or if you are down, it's going to be at an even smaller percentage than if you were not holding some of those European and Asian investments. So now you're probably looking to figure out what to do in your situation. So right now, everybody's gonna fall into one of three buckets. The first bucket is you are scared of everything that's happening and you're worried that your investments are gonna go down to zero. Now, the second bucket that you could potentially fall into is that everything in the news right now is worrying you, but you also understand that the investments go up and down. So you're not comfortable with everything that's happening, but you're not totally freaked out. Now, the very last potential bucket that you could fall into is that this is just another day. This is just another day. You're not fazed by any of the news that's coming out. And to some people, they might actually see this as an opportunity to continue investing. So if you fall into the first bucket, this is what I would tell you to do. The very first thing that I would tell you to do is reassess your risk tolerance. If this is freaking you out like crazy, then you should probably not be in an investment that is as volatile as the markets are. If you're investing in something like a mutual fund or an ETF, I would start looking at some that are a little bit more on the conservative side, that has more exposure to things like bonds and fixed income. So then that way that can help stabilize everything. I would not suggest you moving all of the investments out and completely selling it, because at the end of the day, you are going to miss out on some opportunities that will come up. You just have to make sure that you're investing in something that is right for you in terms of your risk tolerance. Now, if you fall into the second bucket, my suggestion would be, if you have a short time horizon, it might be worth considering reassessing your risk tolerance for the time being. Very similar to the first bucket, I would probably just reconsider going into something that's a little bit more balanced, which is more so you still have about 50 to 60% exposure to the markets, and then the remaining would be fixed income or bonds. This is really where a nice comfort spot is for a lot of people, because you still get the growth of the markets, which, you know, you understand you're a little bit hesitant with the way that the volatility is, but ultimately you know that that's going to happen. But then to give you a little bit more peace of mind, you actually reduce the amount of risk overall by having a little bit of fixed income or bond exposure in your investment. I would still continue to invest potentially just in something that's a little bit lower risk, rather than having something that's a little bit higher risk. Now, if you have a longer time horizon or you're new to investing, I would probably just stay put the way that it is. This is something that is going to happen. These are considered market cycles. And there's always going to be something that will bring investments up or down in value. So this is just something that you have to, I guess, wait it out and see how things go. If over time you become less and less comfortable with the way that the investments are moving, then take a look at the investment portfolio. And if you have to make adjustments, so then that way you're not fully invested in the market, then that's perfectly fine. You could be in something that's a little bit lower risk, that gives you a little bit more peace of mind, so then that way you're not freaking out when the markets are changing. Now, if you fall into the third bucket, which is you're not fazed by any of the market volatility, I would probably suggest to continue doing what you're doing. This is actually a really good time to continue investing, because as the stock market starts to come down, there's going to be more and more opportunity for you to actually buy into the investments at a lower cost. And ultimately what will happen is when things do bounce back, which history has shown that things always bounce back, that you're going to end up on top. Continue what you're doing. If you're investing on a regular basis, on a weekly basis, bi-weekly, monthly basis, continue doing that. And then ultimately you'll find that in the long term, you'll actually end up further ahead versus somebody who has not done that. Now, ultimately, what you decide to do is going to be up to you. This is something that you have to consider. But if you fall into one of those 3 buckets, that is just a piece of advice for you to consider. If you need help assessing your risk tolerance, I would probably talk to a professional. They'd be able to help you out with that, so then they can help give you recommendations in terms of the investments. So there you have it, guys. With everything that's going on right now, those are some tips and things to consider when it comes to your investments with all of the volatility that's going on. If you guys like this video, please leave a like. And also, if you have any questions, please leave those in the comments down below. Also, if you learned something from this video, please share this with your friends and family. At the end of the day, if you learned something from this, I'm sure they will too. It'll continue to help me make it possible to make these videos for you to have this information readily available. As always, guys, stay safe, take care, and we'll see you guys in the next one.